In today's video, I'm going to walk you through what rate of return you should expect from a 60/40 portfolio going forward. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to create a secure retirement. There's a lot of concern recently about what return should I expect from a 60/40 portfolio. We've seen the last few months the bond market has gotten hit quite hard, and because of that, people are worried about what does that mean for the 60/40 portfolio going forward. So in today's video, we're going to talk about just that. And to get a sense of what we might be able to expect going forward, let's start by looking historically. Why has the 60/40 portfolio been so popular? Well, for one, it's had a really strong return. If you go all the way back to 1926 and take a portfolio that's 60% US stocks, 40% bonds, you have an annualized return through the end of December of 2021 of about 8.8%. That's a very strong return when you compound that number over long periods of time. Now, if you break down the individual components, the S&P 500 portion of that has returned about 10.5% since 1926, and long-term government bonds have been around 5.6%. So what you get is a weighted average when you look at the return of each of those asset classes. So that's one component and one reason why people really like the 60/40 portfolio. Another is this. If you look, since 1976, Vanguard did a study, and they wanted to know what's the frequency that both stocks and bonds are down in the same time period. What they saw was this. Over any given month, only about 15% of the time were both stocks and bonds negative. If you extend that to 6 months, only 3.6% of the time were both stock returns and bond returns negative. If you extend that to a year, only 0.4% of the time since 1976 have both stock and bonds returns been negative, and over a 3-year time period, there's never been an instance since 1976 where both stocks and bonds have been negative. Now, this may potentially be the first year where that happens, depending on where things up in 2022 with the S&P 500 and with bond returns, but since 1976 until now, it's never ever happened. So people really like the 60/40 portfolio because number one, it's provided very strong long-term returns, and number two, there's two asset classes that make up that portfolio that tend to work on different cycles from one another. That's what makes it so attractive. Now though, people are very concerned about this portfolio. Why is that? Well, the short answer is because we're human. We're human, and because we're human, we have emotions and we have these biases that we all live with, and it impacts our view as investors. So what we do as humans is we're not looking at the last 30, 40, 50 plus years of history. We're looking at the last 30, 40, 50 days sometimes. And what we're seeing is, oh my gosh, look at the S&P 500 this year. Oh my gosh, look at the bond market this year. You have two asset classes that have been hit hard at the same time. This must mean that the 60/40 portfolio is dead. This must mean that things aren't going to be good going forward. Well, here's the problem with that logic. When you just look at the bond portion of the 60/40 portfolio, you have to understand how bond prices work. Yes, bonds have been hit hard this year, and it's because interest rates have risen. So with a bond, when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. So there's an inverse relationship there. If we look at the bond yields, the US Treasury, the 10-year US Treasury bond yields as of this recording, they're yielding about 2.68%. Look at the 10-year US Treasury yield 1 year ago today, as of this recording, it was yielding 1.26%. Now, all else being equal, what would you rather have? A bond that's paying 1.26% in interest, or a bond that's paying 2.68% in interest? What we have today is a much more attractive yield. So when you're looking at this, what we do as investors is what we do as humans is we look at what's happened recently and we extrapolate that going forward. And the concerns are, oh my goodness, look what's happening. This must mean horrible news going forward for bonds. Well, in fact, over the long term, what's happened is actually positive news for long-term bond holders. It hurts in the moment because, again, as those interest rates have gone up, bond prices have come down, but it means there's a higher interest rate for long-term investors. I would love to know, 60/40 portfolio is the industry standard. What's your desired allocation? Do you have a strict goal for what you want your portfolio to look like, or is it a reflection of something else? Be sure to let me know in the comments below. So what return can we expect from here? Well, not surprisingly, the answer is Who knows? No one knows exactly what the 60/40 portfolio is going to do going forward, but we can use some good information to maybe make some rough approximations. Vanguard has something called the Vanguard Capital Markets Model. And what it does is it models 10,000 different scenarios of stocks and bonds and comes up with a median average of what might we expect going forward from a 60/40 portfolio. And what this model showed, the Vanguard Capital Markets Model, is it projects a long-term average return of the 60/40 portfolio to be about 7% going forward. Now, does that mean it's going to be 7% going forward? Absolutely not. It could be, but it could also be higher, it could also be lower. So make sure that you're not putting too much weight into any single projection, but what we're having here, what we see here, is that's Vanguard's projection, what we might see going forward. Now you might be thinking, well, how on earth can that be? How can we get 7% average returns going forward? Look what's happening in the stock and the bond market today. Well, that's true. So far this year, a 60/40 portfolio is down a little bit over 12%. So you might say, how on earth can we expect 7% average returns going forward with bond yields where they are and with stock markets being overvalued? Is something I hear quite a bit. Well, that's a short-term perspective. Again, as humans, we're wired to look at what's happened recently. We have this recency bias. Zoom out a little bit, even over just the last few years. If you look at the return of a 60/40 portfolio from 2019 to the end of 2021, it was about 14.3%, which means when you tack on 2022's return so far to that 3-year time period, the annualized return is right about 7%. So right in line with what you might expect. The problem is when people project 7% going forward, or when we look at 8.8%, which has been the long-term return of a 60/40 portfolio, it never generates that every single year with perfect consistency. You're going to overshoot and undershoot and overshoot and undershoot, and over time you're going to have an average number that's closer to one of those returns most likely. So what's my advice in all of this? Should you plan for 7%? Should you plan for 8.8%? My advice is to set that aside for a second. My advice is get off of the 60/40 portfolio. Now, it's potentially a great portfolio. It's potentially a great portfolio for you, but it's not unique to you. It's not unique to your own situation. So many people get glued to these rules of thumb. And the 60/40 portfolio is kind of the industry standard portfolio. This is your retirement portfolio. This is a balanced portfolio. Well, maybe, but maybe not. In finance, there's too often these rules of thumb that can be helpful starting points. Now, I'm a big fan of goal-based planning and goal-based investing. What does that mean? It means understand what your goals are and align your planning and align your investing to fit that. What's an example of that? Well, let's say you want to save for retirement. People say, how much should I save for retirement to be on track for my goals? Oh, well, so-and-so says I should save 15% of my income to be on track. Well, that's not necessarily a bad starting point, but if 15%, depending on your situation and how much you want to spend in retirement and what your expenses are going to be in your current portfolio, if 15% is not enough, well, just following that rule of thumb isn't going to help you get to where you want to go. On the other hand, for some people, 15% might be too much. And if you're saving 15%, you're going to have more than enough money to do what you want to do in retirement, but you may be sacrificing experiences and things that you could be doing along the way. That's why I encourage people to find the number that works for them. How do you balance future goals while also balancing current consumption? Same thing is true for investing. We look at the 60/40 portfolio as almost like the holy grail portfolio in the financial industry. But why? Just because it's popular? What makes a 60/40 portfolio right for you? Really, your portfolio should be a reflection of your growth goals, the growth that you need on your portfolio to outpace inflation and increase your standard of living over time. It should be a reflection of your short-term needs. How much do you need to be stable? How much do you need for current consumption over the coming years? It should be a reflection of your own personal risk tolerance. What are you comfortable with in the stock market? How do you need to adjust that mix between growth and conservative assets to fit what works for you? Now, if you go through that and you end up with exactly a 60/40 portfolio, then perfect. That's the right portfolio for you. But more often than not, you're not going to end up with exactly that portfolio. So this isn't to say the 60/40 portfolio is bad. It's not bad. But what it is it's this thing that people think is the be-all, end-all, when in fact it's just a basic portfolio that could be right for you, or it might not be. Now, I might hear people saying, well, James, look at the returns you just talked about. I love those returns, and look at the consistency of those returns. Well, Sure, but look at a 70-30 portfolio or an 80-20 portfolio or even a 100-0 portfolio. All have had much stronger returns over time. So when you look at this, make sure that you're finding the right portfolio for you, not just the right industry standard portfolio that may or may not be most appropriate for your situation. So in conclusion, what do I expect from the 60-40 portfolio over time? Impossible to tell with any certainty. Vanguard estimates 7%. Historically, it's returned about 8.8%. My suggestion, get off the 60-40 portfolio. You might end up getting back there when you go through your own planning and your own investment models, but don't necessarily start there because it's what everyone else does. Find the portfolio that's right for you, that will help you accomplish your goals, and do so in a way that you're comfortable with, and that should be what's most important to you. Now, if you're wondering if a 60-40 portfolio is right for you, or if it's going to have bad returns going forward, you might also be wondering, is 2022 a bad year to retire? Be sure to check out the video above to find out. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.